Hello everyone, we are going to start with another lecture of managerial accounting, and in this lecture we are going to mainly discuss with the concept of cash budgets, right? So cash budget is basically a very simple concept. It usually measures the cash inflow and cash outflow of an organization, which is obviously a very important component of budgeting. So in this lecture, we are going to deal with that basic idea, right? So what we are going to do is we have to record what is the cash inflow, right? And then we have to record cash outflow, and then we have to compute, we have to take the difference and calculate net cash flow, and then we have to adjust opening cash balance in order to get the closing cash balance, right? So this is basically what we are going to do. Cash inflow can be generated through sales, or that can be generated through sales, or maybe proceedings of any sales, or maybe any income, maybe rental income, or maybe anything, right? Cash outflow, there are so many areas where we make payment, like supplier, like utility bills, and there are so many things. So we are going to start with a very basic, very simple question, and I have done most of the calculation, I have already done. So let's try to focus on the cash budget part only. Okay. um, Arcrid Limited manufacture a single product. It prepare monthly budgets for the 6 year months from July to December 2004. Now, we will not prepare for July to December. We will prepare for July to September, 3 months budget, right? Because if we can prepare cash budgets for 3 months, obviously we can prepare for 6 months as well, right? The following standard revenues and costs is available. So the selling price has been calculated as 12 per unit. Material cost has been calculated like this. Labor cost is 1.8 per unit. Indirect expenses are 1.2 per unit. Sales in June 2004 and July 2004 are forecasted to be 10,000 units in each month. Sales volume as a direct result of marketing expenditure of 95,000 in August. Sales are expected to be 11,000 units in August, and they are expected to increase by 1,000 units each month from September to December. Sales after December 2004 are expected to remain same at December 2004 level. So in the first introductory paragraph, the examiner has the situation is actually about the sales volume and a little bit about the marketing expenditure, right? What's next? 25%. Now this is an important part. This is actually something which is related to cash budget part. 25% of the sales are paid when they occur, and 75% sales are paid for the month following the sales. So 25% sales are cash sales, and the balance is the credit sales. Stock of finished goods at the end of each month are required to be 20% of the expected sales for the following month. So this is something which we already have practiced. Stock of material at the end of each month are required to be 50% of the materials required for the following month's production, right? So this is the consumption part. This is also something which we have already done in the previous lectures. Materials are paid for in the month following the purchases. Now this is an important statement. Whenever you make purchases, you do not pay in the same month. You pay after 1 month, right? So if you are making any purchases for June, you will pay it for July. Labor and direct expenses are paid for in the month which they occur. Overheads for production, administration and distribution will be 34,000 per month, including depreciation of 12,000 per month. So how depreciation is relevant in this situation? Because 34,000 is the overall expense, which is not 100% cash expense. Out of 34,000, the 12,000 is related to depreciation, which is a non-cash expense. So whenever there is a non-cash expense, you cannot include it in cash budget. So what we will include in overhead cost, overhead payment will be 34,000 less 12,000. These overheads are payable in the month which they occur, right? So same month payment. The company has 750,000 bank loan at 8% per annum, on which it pays interest twice per year. March and in September. So for us, this September data will be important because we are going to prepare budgets from July till September, right? And the opening balance is 50,000. You are required to prepare production budget and cash budget. So I have already prepared the budgets which we know, right? So based on all these things, I have prepared this budget, right? This budget is actually representing the data from June, July, August, September, and October, right? So let's start with the sales revenue, right? So if I have to prepare budget for July, August, and September, so let's start with cash inflow, right? Cash inflow. So since we are going for July, the assumption is what? The assumption says no assumption. I mean the past pattern shows that 25% sales are paid for which they occur and 75% are paid for the month following the sales. Right. So this means what? This means that for us, June sales will be important. Sales of June were around 120,000, right? July sales are 120,000. August sales are expected to be 132,000, and September sales are expected to be 144,000. So cash sales revenue, or cash inflow from cash sales will be July, right? So whatever we sold in July, we will get 25% of that, right? So 120 times 25 is around 30,000 in July, right? Then 132 times 0.25 is 33,000 in August, and September, May, it's 140 times 0.25 is 35,000, right? So this is the amount which you will get from the cash sales, 25%. And then there is credit sales, amount which you will get from credit sales. Credit sales is dependent upon the previous month. So 120,000, we will get 75% of 120,000. So 120,000 into 0.75 is 90,000. And then same 90,000 will be here. And in September, we will get 75% of August. So 132 times 0.75 is 99,000. So 120,000 will be cash inflow in July, 123,000 in August, and 99 plus 35 is 134,000 in September, right? This is the cash inflow. Now what will be the cash outflow in this situation? For that, we have to see what are the areas where we have to pay. So cash outflow, right? The first which we have to pay is usually the supplier, payment made to supplier, right? So for supplier, the question says that material are paid for in the month following the purchases. So this is an important statement. So if you want to identify how much you will pay in July, you have to see how much you will purchase in June, right? So June material production, finished goods production is 10,000. It's not a cost figure. Consumption is 20,000. It's not a cost figure. Purchase quantity is 20,200. It's not a cost figure. 48,800 is something which we will pay, for which we have bought the material, right? So this 48,480 company will buy in June, but company will pay in July. So 48,480 is the first payment, and 51,360 is the second payment, and 56,160 will be the third payment. Okay, the next payment is to labor, right? Labor budget is 18,000 and labor will be paid in the same month. So 18, 20 and 21.96, right? So payment made to supplier will be, not supplier, sorry, labor will be 18,360, 20,160 and 21,960, right? Direct expense I forgot to calculate, so you just need to multiply 1.2 with the number of units, right? And then there is a marketing expenditure which the company was expecting in August, and that is 95,000, right? And then there is an overhead expenditure. Overhead expenditure was 34,000, but since out of 34,000, 12,000 is depreciation, so 34 minus 12 is 24, I think. 22. So 22 is the overhead expense for all year, for all months. And then the last one is that the company pay interest payment of 750,000 times 8%. So 750,000 times 8% is 60,000, and then company paid twice, so it's 30,000 interest expense. September 30,000, right? And there is no extra payment. So let me pause this video and calculate all these figures, and then we will proceed. So the cash inflow is 120, 123 and 134. Cash outflow is 88,000, 187 and 130. So what will be the net cash inflow? Net cash flow will be 120 minus 88.84, so that is 31,160. It's positive, right? In the second year there is a problem in the second month, because we are about to spend 94,000 in marketing expenditure. So 187.52, 64.52, and then 134 minus 130.12 is 388, so 3,880, right? And what is the opening cash balance? Opening cash balance is 50,000. So the closing balance is 81,160. This will be the opening balance of the second one. So 81,160 plus 64,520 is 145,680. Oh, sorry, what I did. We have to deduct this figure. There's a problem, I think. Yeah, this figure is negative. Net cash flow is negative in the second quarter. So instead of adding it, we have to minus it. So 16,640. And this will be the opening balance of next month. So 123, 127 is, so 16,640 plus 3,880, 20,500. So this is actually how we prepare a cash budget, because all what you need to do is to forecast what will be the inflow, forecast what will be the outflow, and then see how much balance you will be having at the end of the period. So in case of a positive cash balance, we search for what will be the opportunity for investment, maybe in short term. And in case the company is foresee that company will have some deficit, obviously you have to figure out how you can reduce the deficit. Maybe you ask your customer to pay earlier by giving them discounts, or maybe you inform your supplier then that, for example, let's suppose in August will not make the payment, make the 50% payment in the next month, or whatever strategies you want to apply, you can. Or maybe you don't want to spend 94,000 in September, maybe you compromise on that. So whatever the strategy the company will make, that's something which is the basic objective of cash budgets, right? So this was one question which we couldn't do in the class, so that's why I thought let's make a quick simple video of this. This is basically this part. This second table is actually something which we have already done in previous lectures. So if you want to verify these figures, you can simply follow this question and you can try to calculate these figures, right? Take care. Allah Hafiz. Thank you.